Awesome. So let us begin for tonight. So good evening, everyone. Thank you for joining us in this webinar. My name is Wilson from Syfe Advisory team, and I will be the moderator for today's session. And joining us today, we have Ritesh, Head of Investment Advisory from Syfe. He'll be sharing about the economic outlook for the fourth quarter of 2021 and provide some insights on how you can strategize your investment. All right, Ritesh, over to you.
Hey, Wilson, thanks for the introduction. So hi, everyone. Hope you are doing well. Q4 2021, it is 1 year plus since the COVID pandemic. And it's been a wild ride, right? I think the markets have, surprised us upside, downside in all ways possible. But this year is, as interesting as it gets as well, right? It's been a long stretch of gains for the stock market this year. But come September, this was a month where we saw most of the indices sort of lose steam, right? The MSCI All Country World Index fell by 4% and S&P 500 fell by more than 5% for the month of September. Even after the fall, the market was still up close to 15% for the year into 2021. The recent September weakness in the markets basically could be attributed to a variety of reasons, right? There were apprehensions about the economic growth, inflation, impending Federal Reserve tapering of the bond buying program, as well as things related to Chinese equity markets, which is sort of the contagion effects of the Evergrande saga per se. The combination of these factors actually derailed a lot of investors as well from their investment plan, because they were the markets continued rising and now maybe there is this correction that is happening. So maybe it's time to pull out. So, and a lot of the newer investors who started investing post-pandemic, they were not so used to this kind of a volatility, right? But come October, the markets have actually recovered quite well. And, this is on the back of the third quarter corporate earnings season, which actually kicked off on pretty strong results, mainly boosted by a powerful restart in the economy, right? The Dow Jones and S&P 500 indices actually ended up at all-time highs on Tuesday or yesterday, right? On the back of these strong results. Now, given all the recent price action, how do we position our portfolios and our investments going forward is actually top of mind for every investor. So if you go into the next slide, these are basically the top things on mind for every investor, right? Markets are at all-time highs. Now people are concerned about what is called stagflation. There are some concerns on the Chinese growth. And at the same time, how do we think about the markets going forward and our investment strategy, right? So all of these are top of mind. If you go on to the next slide, the agenda for today basically will cover the market snapshot, what has happened through this year, on the broader markets, asset classes, geographies, stuff like that, economic outlook going forward, and then a little bit more on investment strategy, right? What are the ways for us to position our portfolios as we move forward? And we'll wrap it up with a little bit of an introduction to Syfe. So people who are new to us and have joined us, our webinar for the first time, I hope this will be a little bit informative and you will get to learn about Syfe as well. And then we will wrap it up with Q&A as well. In the middle as well, if you have questions, please feel free to reach out. There is a Q&A tab, so please post your questions. Wilson will sort of collate all of them. And then I will take some pauses in the middle. So hope to address as many of them as possible. All right. So let's move on to the market snapshots, right? If you look at this particular slide, what you're looking at is earnings, right? And these are the technology bellwethers: Google, Microsoft, Tesla. And what you would notice is, come October, the start of October, the whole focus of the market has actually shifted from inflation-related concerns to corporate earnings. And roughly till now, around 30% of S&P 500 companies have reported their earnings. And out of that, around 82% have actually topped the earnings expectations. So what you're seeing here with Google, Microsoft, and Tesla is basically companies topping revenue expectations, with Microsoft essentially reaching as much as $20 billion of profits. Just imagine $20 billion of quarterly profits. This is a first for them, first time for the time that they have been in existence. So $20 billion is quite a big number. So while we do worry about bubbles in the economy and all, part of the rally is also driven because of these strong earnings that we are seeing in the market per se. Similarly, if you look at shares of Tesla, up 12.7% on Monday, and it closed at more than $1,000, topping like $1.01 trillion in market cap, right? Like, this is just insane just to think about where Tesla was a year or two back versus where it is right now. And this was basically on the back of news that Hertz, one of the car rental companies, is going to buy around 100,000 Tesla cars. And what is even more, I think, astounding is the fact that with this market cap of 1.01 trillion, Tesla is actually now worth as much as the next 10 most valuable global automakers combined, right? Like, just insane to imagine. A lot of people, a lot of investors are interested in Tesla. So this is just like goes to show how innovation is also driving growth for a lot of these technology companies, which are essentially, sort of creating the future world for us. Now, if we go on to the next slide, markets are at all-time highs, right? And again, strong corporate earnings is a big factor and a big catalyst behind these recent record highs in the market, right? Like, there has been robust demand, and these robust demands have actually offset what you have observed in terms of supply constraints and pricing pressures as well. The S&P 500 has advanced actually for the last 9 out of the 10 sessions, and this is again driven mainly because of the positive and topped expectations of earnings reports that are trickling in for the third quarter. On the macro or leading indicators front as well, we just saw the US new home sales numbers come in. So they came in at around, I think it was 800,000 as a number in September. The consensus was around 760K. So goes to show that there is all-round growth that we are observing throughout the economy, and there is a strong demand for housing as well. So overall, what we are noticing is that there is some seasonality associated with it, but there are net improvements in the markets, and there are some signs that the COVID cases, even with the Delta variant, is starting to peak out, which has basically provided the potential for the equity markets to continue their run as we approach the year end. Now, if we look at the next slide, it talks a little bit more about the asset class performances as well as different market performances as well globally. So if you look at the US and the European markets, they have sort of been up between 15 to 20% for the year, and they continue to grind higher. In contrast, essentially, if you look at the Asian economies, what you'll realize is there have been laggards, and particularly China, right? Like, China is still down around 10% for the year. October was still a better month for Chinese equities. A lot of stocks started to recover, but even with the recovery, they're still down 10%. They were down, I think, as much as 18 to 20% coming into October, but October has been so far a better month for the Chinese equity markets. So, I mean, the reason for that obviously has been the regulatory headwinds and the recent Evergrande-related contagion risks as well. If you look at the chart on the right, I think this is much more interesting because it shows how commodity prices have sort of surged, and also on the back of, again, inflation concerns, supply constraints, all of these, right? So this is one thing that a lot of people are now watching, because the energy prices, crude oil, all of them have surpassed, like if you look at return standpoint, they've eclipsed the kind of price increases that you're seeing for the equity markets as well. This is mainly, again, as I said, like driven due to supply shock as the restart of the economy happens. It also brings to question, and there are parallels being made, that is this similar to what happened in 1970s, where there was this era called stagflation. And stagflation basically means that there was this period where there was a weak sort of economic growth or a stagnant economic growth, and it was coupled with high inflation as well. And this particular phase was also dominated because of supply constraints. So there were supply constraints, and on top of that, there was stagnant economic growth, which led to this stagflation era per se in the 1970s. We will explore this a little bit more in the next section to understand what the economic growth prospects and inflation guidances are going forward. But again, this is something that is top of mind for a lot of investors as they're evaluating how the markets behave going forward as well. So if we move on to the next section, we are looking at the economic outlook, right? And on that, if you look at this particular chart, this is basically growth projections that have been put in for across the world by IMF. Overall, the economic outlook looks good. The numbers from a global growth standpoint stands at 5.9% in 2021 and 4.9% in 2022. This actually, from a 2021 numbers perspective, the economic growth is 0.1% lower than the July projection that was given by IMF. So there is a downward revision, but it is not major, right? So there is a slight downgrade or a downward revision that you're seeing. But mainly, I think if you were to attribute it to something, it will be partly due to supply restrictions or disruptions on the more advanced economies, as well as on the other side, it is the worsening pandemic-related dynamics in the low-income developing economies as well, right? Overall, though, like it is offset by sort of the near-term prospects that some of the commodity exporting emerging markets and developing economies will also benefit with the price surge that you're seeing. And overall, there doesn't seem to be any marked slowdown in economic activity. In fact, economic activity continues to rise at a brisk pace. And again, there is room for it to continue its run, forward in the coming months and the year forward as well. So one more number, I guess, like if you move on to the next slide, that is, in everyone's mind and everyone is watching, is the 10-year US Treasury yield, right? So this number topped 1.6% not so long ago. It actually went all the way up to, I think, 1.68%. And only just last week, it has come down to 1.6%. But compared to where the US Treasury was a year back, it's almost double, right? So this is basically, again, on concerns of inflation, as well as potential Federal Reserve tapering of the bond buying program later into this year as well. Now, again, I think it is important to note that, what do we attribute this inflation, the surge in inflation as well? It's, again, majorly driven by supply shocks, right? So there are producers who have sort of struggled to meet the resurgent demand. There are, things like ports which are clogged because of increased sort of shipping costs. And there are surging sort of commodities that have added to these price pressures as well. And again, if you look at this particular situation, it closely resembles what happened in 1970s, where again, there was like an oil embargo by producers and which sort of triggered a huge spike in the oil prices per se. Now, so today, I think today's oil price surge naturally raises that bigger question of whether we are in an economy similar to 1970s, which is like a stagflation, where we will have a period of high inflation coupled with slow growth, right? So that is an important, I think, question for all of us to have some understanding of and get a guidance on as to how we can think about it going forward as well. So if you look at the data on the next slide, what you will realize is, this is a graph that we've actually sourced from BlackRock. It shows how oil prices. So if you look at the yellow line, that is the oil prices, and its movement in tandem with what is the resurgence in economic activity, which is the red line per se. And what this tells you is essentially there is a correlation between them, right? It tells us that there has been, it's really the growth, right? So the resurgence in economic activity, which has led to this rapid increase or the rapid clip in the oil prices as well. And this growth is what is driving these price movements as we speak. So rather than stagnating, actually, the oil price surge is to be expected in this kind of an environment, right? Because as we are restarting, there will be these supply constraints. And because of those, the oil prices are moving up. Overall, I believe this is more of a growth-driven oil price increase rather than, because there is slowing growth and stagflation per se. So in our opinion, and also looking at a lot of data consensus around the street, it looks like the current price increments that we are seeing in the commodity world and inflation environment and all is mainly driven due to supply constraints. And in fact, from a growth standpoint, it is more of a growth-related rally rather than just on the front of slowing growth and stagflation-oriented metrics per se, right? So that's very important to note as we move forward. Now, if you look at inflation itself going forward, it is important. I want to just reiterate that essentially inflation expectations have been higher for this year. And they are basically, if you look at the last couple of months in September, August as well, inflation sort of moved to a peak. But after reaching that peak, I think it reached around 4.9% on a month-to-month basis. And then it started to sort of taper off. And while it might not start to go down on an immediate basis, but if you look at 2022 and the later half of 2022, the inflation expectations are supposed to moderate out. So if you look at this chart across the world, you are seeing that the inflation numbers from a 2022 perspective are expected to moderate. And the overall expectation is that while the restart pressures might persist well into 2022, but eventually these will subside as the near-term sort of supply-demand imbalances ease out as well, right? So I think like the bigger question is like, how will the central banks move, right? Like, what if they start tightening too soon? That could actually be a bigger risk, in my opinion, in the markets right now, and can give kind of a wrong signal to the markets that, okay, there is real big inflation. And because of that, the Fed is sort of, or the central banks are taking action. And that could lead to corrections in the markets and stuff like that as well. But I think like, again, the Federal Reserve hasn't given any strong indications of rising interest rate in the near term. They will embark upon tapering off of the bond buying program. But even there, they have not been, very detailed as to how they will go about it and what amount they will start tapering off as well. So, looks like they also subscribe to that same view that essentially this is a temporary rise in inflation and it might persist for the next few months and all. But coming into 2022 and later, these things will moderate out as the supply-demand imbalances ease out per se, right? So I will just pause here for a bit because I think it covered quite a bit of data points. So we covered like the market snapshot, we covered the economic outlook, as well as expectations from inflation, as well as other leading metrics per se as well. So Wilson, I'm just checking in if there are any questions for us to look at immediately. Otherwise, we will just continue.
I think the viewers are still digesting the large amount of information that you are sharing. At the moment, we do not have any questions, but we can touch on some at the later part of the webinars.
Got it. All right, so let's move on to the next section, which is more on the investment strategy side of things. But even before moving on to investment strategy, I think it is important to look at, again, some high level data, which again are playing on investor minds as well, right? So the first thing is to look at valuation, right? And everyone, I think, realizes that the market valuations are pretty high. And because of that, investors are concerned that if the valuations are so high, does it make sense for us to remain invested per se or not? Now, if you look at the valuations on a standalone basis, yes, stock valuations do look elevated today, right? And now to the extent that in certain segments, there is like that bubble formation, if you would say so as well. But when you put the equity valuations in context of the current level of, risk-free rate and bond yields, they are not unreasonably stretched. This is what this graph essentially is trying to capture. Now, why do we say that? It's mainly because if you look at the US Treasury, like the 10-year yield, it's still below 2%. It is 1.6% as we speak. And for equities, if you look at how to measure equities, the better measure for valuing equities is actually the excess return that you can generate from the equity market compared to the risk-free rate, which you can consider to be the US 10-year Treasury. And this is what is known as the equity risk premium, right? So from an equity risk premium, the equity market is still giving you a much, much better, risk-adjusted return. And this is what this, red line essentially indicates, right? So if you look at the chart, the equity risk premium has been well above its long-term average for the past 10 years per se, right? So essentially, it suggests that the 10-year Treasury yield will need to double, right? So even from current levels, it will need to double to sort of compete with equities from a risk-reward standpoint. And that basically implies that stocks are, kind of undervalued on a relative risk reward basis, not on a standalone basis, but more from a relative risk reward basis per se, right? So it's important to note that aspect as well when you're looking at equity valuations. If you look at the next slide, essentially, people are also concerned that like markets are at all-time highs, right? Like, what do we do? And does this mean that there is a correction on the horizon? I would again like to highlight and remind a lot of our investors that if you look at 2020, the markets made a huge downturn. S&P 500 dropped by 34%, but then it came back up, rose more than 50% for the year. And by the end of the year, it was up 18%, right? Now, at that point as well, it had eclipsed its previous highs, and basically it was at an all-time high. At that point as well, investors could have questioned that this rally, will not persist. And if you took your money out at that point of time, you will sort of lose out on the 20+% return that the market has generated year-to-date basis as well. So it is important to note that just because markets are at all-time highs doesn't mean that there is a correction coming, right? And that's what this particular chart tries to capture. Essentially, this is a chart that we've sourced from the UBS analysts, and it shows that the probability of a more than 10% correction when the market is at an all-time high is actually 30%, versus if you started at any random point, like the market was at any random point, not at an all-time high, the probability of a 10% correction is 36%. So the probability is higher at a random point than at a market high, right? So it's important to note that just because markets are at all-time highs is not a strong indicator. In fact, it's a weak indicator of future market pullbacks. So very important point to note that as well. All right, so now let's look at the next slide. So, what I'm trying to sort of emphasize on is that it pays to remain invested. If you just look at the last 2 months, how the markets have behaved, this is basically S&P 500 index fund. So this is CSPX, which is a UCITS ETF on S&P 500, which covers basically the US stock market as a whole. And if you look at the value of your portfolio, if you would have invested into this, say in August, September, your value would have gone down in September, right? Like S&P 500 was down, more than 5% during that time period. So you would have experienced that downturn. And if you would have panicked during that time and sold off your investments, basically you would have captured some losses, and you would have, thanked that, oh, at least I've come out and I will not be subject to further losses in the market. But come October, the markets have rallied back, right? Like, as I shared, the markets have rallied back on the strong corporate earnings that we are seeing in the market right now. So what I'm trying to emphasize is like it pays to remain invested. It is important to have a long-term perspective and, sort of look past all the scary headlines that you see in the market, right? Like, the associated volatility in the market. It is important to keep your eyes on why you're investing, what are your goals, and keep a long-term perspective when you are doing that as well, right? So if you remain invested through these last 3 months, essentially, you will realize that the ETF has actually recovered all its losses, and it's actually even higher than the early 2021 sort of September levels per se, right? So again, reiterating the fact that don't get panicky on short-term market fluctuations. This is just part and parcel of investing. So if you have a long-term sort of investment commitment and you have long-term goals that you want to attain, make sure that you choose your appropriate risk level and all. But reacting on short-term market-related news is not the best solution when it comes to generating returns and wealth accumulation per se as well. Now let's look at the next slide. So why does it pay off in the long term, right? If you look at this slide, it basically shows you if you look at the top row, it shows that if you invest for 1 year, there could be positive years, there could be negative years. But as you start investing for more years and remain committed and don't like churn, what you realize is the probability of you losing money substantially decreases, to the extent that if you invest for 20 years, there has been no 20-year period. And this is data going back 150 years where you have lost money if you invested into a broad-based equity market such as the US stock market, which is S&P 500, right? So it just goes to show that, from a long-term perspective, if you are an investor who can remain committed, if the economy broadly grows, you will also participate in that. All right. So now let's look at China, because this is really, really interesting. This is something that has also impacted a lot of clients in this part of the world, because all of us do have some exposure to China, and the price action that we have seen in the Chinese equities have not been ideal for us to go through, right? Like the kind of volatility that we have seen. Now, if you were to map out what is happening in China, the slide in the Chinese stock market actually sharply sort of accelerated in September. The whole of this year was kind of bad for China. Last year, Chinese equities did really well. This year, on back of regulatory action that you've seen, as well as the September news which came in on their top property developer, which is Evergrande Group, defaulting on their bond payments, led to more contagion related risks in the market, and it sort of could have led to a meltdown in the financial and consumer sectors more broadly as well. So Chinese equities did suffer through quite substantially going into this year. Were down close to 18-20% up till September. In October, they have started rallying back. If you look at Evergrande Group, they have made payment on the coupon that was due. It was due last month, but they had a grace period of 1 month to furnish that coupon. So they did make that payment, and that has brought some relief in the Chinese equity markets as we speak. Also, it is actually pretty important to note that in the Chinese market, rapid and targeted regulatory actions are fairly common in China, right? But they are also followed by sharp rebounds in share prices, which are driven by broadly favorable policy actions by the Chinese government and the policymakers per se. So it is important to note that there is a bear market almost every year in China. So this chart basically depicts that there has been so many negative years in the Chinese equity market. In fact, 17 out of last 20 years, the market has gone down, right? So essentially almost every year, the Chinese stock market has a negative period associated with it, and usually driven by some kind of policy concerns or policy action per se. Historically, however, investors have been well compensated for taking that extra risk, and they have been sort of rewarded with strong annualized returns as well, right? So if you look back from a historical numbers perspective, from August 2001 all the way to August 2021, the MSCI China index has produced an annualized return of 12.3%, which is outperforming the 9.3% return that you would have generated through S&P 500, which is the US stock market. So again, I think for China, it is important to note that there will be volatility, there will be maybe policy actions. They have implemented things around common prosperity for the overall Chinese market per se. So that might have sort of implications on specific sectors and all per se. But overall, I think it broadly elevates the economy in the long term. So they are basically ready to sacrifice short-term gains with the view that in the long term, it will pay them dividends, and it will have a more sort of equitable distribution of wealth amongst its population as well. So it is important to sort of have that understanding of China when you're investing there, and keep, again, that long-term perspective, because as you can see from a historical perspective, if you have invested into China, you will go through these periods of high volatility, but it will be also followed by sharp rebounds and outsized returns as well, right? So, and this is something that you've seen on a month-to-date basis for October for some of the Chinese equities as we speak. Now, coming to the next section, I think this is again something which is impacting a lot of investor minds. So we're talking about the S-REITs market. So this is the local Singapore REITs market, and the performance has been in focus because with the implementation of heightened restrictions in Singapore amidst rising COVID cases, the S-REIT performance has sort of fluctuated as well. And what that has meant is if you look at the index, right, the iEdge S-REIT Leaders Index, which is one of the key indices that measures the performance of the Singapore REIT market, that index has lagged the performance of the global equity as well as the REITs market, right, coming into this year. But I think what is important to note is this has definitely tested our patience. But it is important to understand that the long-term attractiveness of the S-REIT market remains strong. And why do I say so? It's mainly because if you look at the S-REIT market just from this graph, what you'll realize is from a risk and reward standpoint, S-REITs actually give you the highest, one of the highest dividend yields. So the dividend yield for the portfolio that we have, which is called the REIT Plus portfolio, which tracks the IHS REIT Leaders Index, is close to 5%. And given the low interest rate environment, I think that is highly, highly attractive. And on top of that, the volatility or the risk associated with this index is much, much lower compared to a global REIT benchmark. So if you compare this against the FTSE EPRA NAREIT Global REIT Index, what you'll realize is that you're taking less risk and the overall return that you're generating is much, much better. So if you look at the 5-year return, the return numbers are not here, but essentially the last 5-year return for the IHS REIT Leaders Index is close to 60%, versus for the global REIT index, it is 28.2%. So more than 30% high is what you're getting from the Singapore REITs market. And why is that so, right? Like, if you look at the next slide, you will see that the Singapore market, REIT market, is actually pretty diversified and pretty robust as well. And this is mainly because if you look at the IH index, it focuses on high quality Singapore-based REITs, and it has exposure to some secular growth sectors such as your data center, your industrial, healthcare, logistics, all of these sectors, which are again, in that secular growth trend, which I believe will continue to happen going forward as well. So I genuinely believe that essentially, if you are investing for the long term and you don't want currency risk, S-REITs should have some part to play in your portfolio as well. All right. Now, I think just wrapping it up a little bit more from the standpoint of, while we've talked about Chinese equities, while we have talked about REITs, we've talked about equity market, bond market, it is important to remain diversified, right? And this is one of the only things that comes for free for you. These all markets, like there will be ups and downs with the markets, right? There will be some years where, particular sectors will do really well, or particular asset classes will do really well, or particular geographies will do really well. But, there is no guarantee that that will continue from year-on-year basis as well. And that's why if you remain diversified, what you'll observe is you might not always end up at the top. And this is what this sort of chart shows you, that if you, sort of invest into a more diversified portfolio, you are still getting a pretty decent return of close to 7%, but the risk that you're taking is substantially sort of reduced, right? So it is at around 10% volatility, versus if you're investing into very focused sectors and all, you're exposing yourself to much, much higher risk. And what that means is you will be, you will have to be comfortable going through bigger drawdown periods and all as well. So again, my 2 cents is that in terms of thinking of your long-term investments and plans, make sure that you evaluate your risk well and invest in a diversified global portfolio to begin with before you take action on very specific investment opportunities per se. If you go on to the next slide, this is another important question that a lot of our investors ask us, right? Should I do lump sum investing? Should I do DCA? And I thought that this particular chart was very, very powerful because it captures, what will happen if you invested, say, start or just before the financial crisis, right? Like 2008, the markets again went down like 30-40% plus if you invested a lump sum amount of money. And this is, say, the red line, and the light red line is the pure equity portfolio. So what you'll realize is, of course, if you invested a lump sum, you would have gone through a lot of drawdown period during the 2008, 2009 crash. But what I think is even more powerful to notice here is the subsequent recovery that you're seeing in this particular investing methodology. So the dark red line comes out on top because essentially, the whole amount of money that you invested participates in the rally that was there post the financial crisis, and the returns keep compounding over time as well. Versus if you invested DCA basis, right? So you keep contributing regularly, you would have gone through a much sort of stable profile going into these corrections and all. But over the long term, you would have to sacrifice some of those returns, assuming that the market sort of, continues to grow and all per se. The same thing is also seen for a 60-40 kind of a portfolio. So the returns for both lump sum and DCA are a bit lower, but essentially, lump sum kind of wins over a DCA methodology. Now, again, I'm not saying that, lump sum is better than DCA. What I'm, just highlighting is that over a longer duration of time, what is more important is to remain committed to your investment plan and, not be affected with the markets too much. And you will naturally sort of accumulate, and there'll be compounding happening and things like that as well. Of course, if you're concerned about the markets right now, and you want to have a much, sort of smoother ride going into, the current situation and all, the DCA methodology will give you that stable profile, because if the market does go down, you will end up buying more units at lower prices. But again, if you're thinking from a long-term perspective, I think the answer is a mix of the two. So you should definitely have a combination of both lump sum as well as DCA in your investment strategy. All right. So let's do a quick summary. So, what have we learned today, right? Essentially, market pullbacks essentially could be very, very uncomfortable, but they're just part and parcel of investing. And we sort of encourage everyone to remain invested and maintain a long-term perspective. Also, market highs are kind of weak indicators of future corrections. So, just because markets are at an all-time high does not mean that there is a correction coming. We are structurally positive on China. And as we highlighted in the slides earlier, historically, investors have been compensated for that extra risk that they're taking. S-REITs, the Singapore REIT market remains highly attractive with higher dividend yield and lower volatility compared to the global benchmarks. And last but not the least, it is important to stay diversified and remain invested. So, again, I'm just reiterating, as the saying goes, time in the market is much, much important compared to time in the market. So please do remain invested as well. All right, so I think that brings us to a close on all the market-related data points that we had for today. So Wilson, do we have any questions so far?
Yeah, we do. So actually, one of our viewers are asking regarding China, investing in China. So we keep mentioning about investing for the long term. Do we really have like a definition of how long is long? Is like 10 years, 15 years, or 20 years?
Yeah, so that's a good question. See, I think when we say long term, it basically means that you should be able to go through a phase of correction and recovery, right? Like, if there is some market event that results in significant corrections in the market, you should be able to give your investment sufficient time to recover. And that typically means that at least like have a 3 to 5 year horizon to begin with. Once you have an investment horizon beyond that, typically the probability of you losing money tends to go down substantially, right? So when we talk about long term, it basically means that have that 5 year plus kind of an investment horizon.
Awesome. All right. So one more question is regarding cryptocurrency. So one of our viewers is actually asking, like, I know, what is the recommended percentage shall we be allocating to cryptocurrency? Do you have like kind of view on this?
Right. So see, I think like, it's a very exciting world of cryptocurrencies right now. And again, like, what I would say is that cryptocurrencies have gone through, pretty volatile periods. There have been, a lot of previous phases in the market where they have been a pump and dump kind of scenarios. So it is a pretty risky sort of an investment vehicle per se. But I think coming into 2021, I have seen more institutional kind of adoption of crypto-related assets. So there is definitely more, kind of acceptance that I'm seeing across the board. Now, in terms of, is it a real asset class and can we have it as part of the portfolio? I'm still not sure. I would say, given the kind of volatility associated with this kind of, exposure, it should still be a very, very small part of your overall investments, right? So in my case, I would say maybe having anywhere between 1 to 3% kind of your investment parked into assets such as cryptocurrencies. And I would still treat that allocation as something which I'm willing to lose all, right? Like, I personally consider it still to be like casino money. If it gives me great returns, that's great. But if I lose it, I don't get derailed from my financial goals per se. I think that's the most important part. So as long as you've got your broader aspects covered, and that's what we at Syfe focus on, right? So the idea of Syfe is to make sure that your core investments are taken care of. So as long as you have invested your taken care of your long-term goals, and for that you have a diversified portfolio, which means that almost like 60, 70, 80% of your money is invested in a diversified global across asset class kind of a portfolio, then is the place where you can start affording to take some specific exposures as satellites. And within that satellite as well, crypto can be a small allocation per se.
Awesome. One more question is about one of the market that we, some of us have not been talking about it. So one of our viewers is actually asking about the outlook for India.
Oh, wow. All right, great. So I think, India has just been an incredible run over the last 1 year since coming out of the pandemic. And, early this year was not great when there was that second phase or the second wave of COVID pandemic. And I think it, went through an insane phase where, the economic prospects looked pretty bleak kind of a thing. But if you look at, how the Indian market has sort of made a comeback over the last, say, 6 months or so. I mean, not just last 6 months. I mean, the markets continued their rally post-pandemic, and they have continued to rally. I think there has been a tectonic shift in the Indian market, and a lot of things that are happening there are kind of leapfrogging into the next stage. So when it comes to technologies such as 3G, 4G, 5G, things like internet adoption and stuff like that, all of these have moved from in the Western world, they went stepwise and all. In a country like India, they've just leapfrogged from a traditional mobile phone, which was not a smartphone at all the way to a smartphone enabled with web enabled sort of smartphone devices. And there has been players who have come in and filled all these gaps, and the market itself presents a huge opportunity in just the sheer size of the economy itself. So I think it is at the cusp where there is a huge amount of interest in India, and there is that aspect that it is right now at that inflection point where it is the market's opening up, and overall there is a high degree of positivity associated as to what the economic outlook might look like in the near future. Plus, I think there is overall some political stability as well, coming into the second term of the government that is ruling in the country as well. So all of those factors combined have actually helped India, I think, sort of regain the kind of the largest, I think one of the largest economies, but the growth rate is highest amongst the larger growing economies per se. So I remain highly positive from a medium to long-term perspective on India on that front.
All right, awesome. I think we can move on to the next part of our webinar.
All right, awesome. So let's cover a little bit more about Syfe, right? So what is Syfe? Can you move on to the next slide, please, Wilson? All right, so Syfe, we are a digital wealth manager. We are headquartered in Singapore. We are here to build the next generation of financial solutions for individuals across Asia. We are licensed by MAS, so the Monetary Authority of Singapore. So we have what is called as a CMS license. This license allows us to manage money for retail as well as institutional investors. As part of this license, we are required to make sure that all client money is kept separate from our own money. And this basically ensures that even in a worst case scenario, something happens to Syfe, your assets are protected and safeguarded as well, right? So that is very, very important. In terms of our journey so far, we were gone live since 2019. So, close to 2.5 years since we have gone live. In terms of our customer base, we have customers from over 42 different countries. Our youngest customer is an 18-year-old to the oldest one who is a 93-year-old. And I think if you just look at our more recent journey, what you'll realize is we are one of the leading personal financial apps. If you go onto the Apple App Store or Google Play Store, you will find us right at the top. Our assets essentially grew more than 4x just in the first half of 2021. So thank you, all the folks who are already invested with Syfe. Thank you for your support. But I think all this basically means that we are continuing to grow rapidly, and with significant sort of money that we have raised through marquee investors. These are very strategic investors who are backing us. We are continuing to sort of innovate and sort of embark upon the next phase of growth for us as well as for our clients as well, right? And that's the reason you see things like, we have been awarded by Digfin as one of the best or the best digital advisory solution in Asia. If you look at the next slide, let's cover a little bit more about the Syfe portfolio. So essentially, we have four different segments, and each of these segments, essentially, we have designed our portfolios to cater to specific client needs. So whether you have a savings related need, income related need, growth related need, or you want to personalize your own portfolio, these are all solutions that are available within Syfe, right? So the cash plus portfolio is an alternative to a savings account. I mean, it is not really a savings account itself in the sense that it is not capital protected and stuff like that, but it invests into very high quality money market and short duration bond funds. And the projected yield is 1.5%. And the good news is there is no lockup, there is no limits, there is no tiers. So essentially, you're getting a much better return on your profile at a very, very low risk kind of a manner compared to money just sitting idle in a bank account per se, right? In terms of income, there is this REITs portfolio. This is one of the most popular portfolios on our platform. We covered the S-REITs market in the Outlook section today. And while the S-REIT market from a price return standpoint has lagged the global benchmarks for this year, the dividend yield remains pretty strong. And I think going forward, given the secular exposures that the REIT portfolios have, I think there is a pretty attractive yield play as well as growth play with respect to REITs. And it actually also acts as a way for you to hedge your exposures to the global markets, right? So this is Singapore dollar denominated. So that basically means there is no sort of direct currency risk that you're taking with this portfolio as well. Then we have our core portfolio. So this is where, if you have long-term goals, so whether it is retirement planning, financial independence, children's education, any such goals, and you want to invest in a diversified manner, that's where the core portfolios come into play. And these are portfolios that are a combination of equity, bond, and gold. And we do all the sort of legwork on your behalf in terms of making sure that the portfolios remain optimized. We try to minimize the amount of risk that you're taking. And the objective function is to maximize the risk-adjusted returns that we can generate for you, right? And there are portfolio options available within this. So depending on your investment time horizon, depending on your personal risk appetite, you can choose a defensive portfolio, which is just 20% equity, or you can take more aggressive portfolios. So the balanced portfolio is 40% equity, growth is 70% equity, and equity 100 is the 100% equity portfolio. On top of that, what we have done more recently is that we have listened to our clients' feedback, and we have taken personalization of investment to the next level. And that's what the Syfe Select platform enables for you, where you can choose your own sort of underlying investments and create your own portfolio to your liking. We still believe that in terms of constructing your portfolios, if you go on to the next slide, you can follow what is called a core and satellite framework of investing. So if we can go on to the next slide, Wilson. Right. So basically, what is the core satellite framework of investing? A core satellite strategy basically means that you have a globally diversified portfolio as your core, where you invest almost 60, 70, 80% of your money. And that ensures that you remain committed to your long-term plans. And that's where our core portfolios can come into play. And then you put satellites, where essentially you want to express specific views in the market. You want to take sector bets. You want to get exposure to certain secular thematic trends. You can do so via our Syfe Select offerings. So we do have thematic portfolios like technology, innovation, growth, specific trends within particular countries like China, as well as if you want to align your investments to the values that you have, right? Like so ESG and clean energy related things as well. So please do take a look at these options that are available for you. And I'm sure that there will be things of interest there for you, everyone, there for everyone as well. All right. In terms of getting started, it's pretty straightforward. So you can download our app through the Apple App Store or get it on the Google Play Store. Everything is shown upfront to you, so there is no need to sort of sign up in terms of just looking at the different portfolios and what they're composed of. This is transparently available to you even before you create an account with us. Right? Once you decide what portfolio you want, you can actually do some forecasting in terms of how the money will grow. And it will show you scenarios on a more conservative basis, more likely basis, and an optimistic basis and all as well. So helps from a planning standpoint that how can my money grow to the specific goals that I have in mind and all as well. In terms of onboarding, very, very easy. If you're onboarding via MyInfo, it's literally 3 minutes that you can onboard. Once you onboard, everything is shown transparently to you, whether it is what's the value of your portfolio, what are the components of your underlying investments, transactions that are happening on your portfolio, fees that you're paying, everything is transparently shown to you as well. If we move on to the next section, in terms of pricing, it's pretty straightforward. I think the good news is that there is no minimum for anyone to get started. This is the value proposition of Syfe, that we are democratizing access to smart and sophisticated investment strategies, institutional level offerings for anyone and everyone. So whether you have a few $100 or $1,000 to invest, or whether you have $1 million to invest, there is a Syfe portfolio available for you. Of course, the fees keeps coming down the more you invest. So if you invest less than 20,000, then it is 0.65% per year. As you invest more, the fee progressively keeps coming down from that level to 0.5%, 0.4%, and 0.35% as well, right? On the cash portfolio, there is actually no fee at all. So this is a portfolio free of charge. And again, this is a way for us to showcase to you that essentially it is like very, very low barrier to sort of get started and at least try the platform out. If we go on to the next section, so yeah, and I think it's important to highlight that there is no kind of hidden fees. Typically, a lot of traditional platforms will have entry charges, exit charges, brokerage fees, all of these sort of hidden within the products that they are marketing to you. But on Syfe, essentially, we absorb all trading costs. We don't have any entry fee, exit fee. There is no minimum balance for you to get started. You can take your money out at any point of time, so there is no lock-in. When it comes to management of your portfolios, we manage your portfolios, optimize them. You don't pay anything for that. There is dividends that get automatically reinvested. You can switch between portfolios without any extra cost incurred on your behalf. And the ETFs, I mean, we implement all our portfolios. I think it is a very important point that we implement using passive instruments. So the cost of these underlying instruments is really, really low. Last, I think very important just to highlight, if you compare the Syfe platform vis-a-vis doing it yourself, I think there are some implicit costs associated when you're doing your investments by yourself. So, the amount of time that you're spending to track the market, and there is no guarantee that if you're doing it by yourself, you will really outperform the market as well, per se. But more importantly, I think, there are a lot of heavy lifting that we are doing on your behalf, and we are sort of, in a way, managing your portfolio and keeping track that things are going on smoothly. And whether it comes to risk management, whether it comes to re-optimization, whether it comes to how you are deploying your funds on a regular basis, you don't have to worry about brokerage costs. You don't have to worry about dividends getting reinvested. You can have a mechanism where you put in money into our cashless portfolio and have recurring transfers going into our investment portfolios without any extra cost on your side as well, right? So again, it is all these factors combined which provide you the value, hopefully, that justifies a very small fee that we charge, which is starting at 0.35%. All right, so there are also some upcoming webinars, so please do stay tuned. So next week we are covering the Singapore REIT market, which will be covered by Dhruv Arora, our CEO. And last but not the least, we have a very strong team of wealth experts. I think, Wilson, you're missing in this slide. I don't know why, but I think we have a newer photo taken, so we should definitely put that in because you do figure there. But Wilson and the team is highly qualified, so do reach out to us. I think this was a lot of information that we covered in a relatively short period of time. But if there are any questions, please do reach out to us. All right, so I think we are close to 8 p.m. So maybe a couple of questions before we wrap it up.
Yep, sure. So we have one particular question regarding the China market. So with all these technology sector control, real estate issues, what do you think will be the turning point for the China market moving forward?
Yeah, so see, I think it's difficult to say what really would be the turning point. I think there could be continued policy actions because a lot of these have been in draft stage, and markets have been reacting just basis on the knowledge that these will be implemented per se. So there is still a room for continued volatility in the Chinese markets going forward. But as I highlighted earlier, I think what is more important is to understand China and understand that they're ready to make shorter term sacrifices to achieve a greater good in the future. And what that means is if you're investing into a market like China, you really need to have at least a 3 to 5 year investment time horizon. Again, I think the important point to highlight is that you will have phases of ups and downs. And in fact, in the last 17 out of 20 years, markets have gone down on these years as well, right? Like out of 17 out of the 20 years that you have seen in the past. So there is no reason why it cannot keep happening again. So it will definitely not be a one-way street. But if you just remain invested, I think the investors have also gotten compensated with outsized returns when there is a sharp recovery on broadly favorable sort of policy actions from the Chinese regulators and policymakers.
Great. So I think that's all for today. So thank you, Ritesh, for the extensive coverage. I believe the viewers took away a lot from your sharing. Thank you everyone for joining us tonight, and we hope you have a good night ahead.
Thanks everyone. Have a good night.